I'd like to thank everybody for joining me today. Today, I want to talk about helping our clients fund their buy sell agreements. If you look at a buy sell agreement, it really can be a nice agreement, but it's not actually going to do what they want unless it's properly funded. So, as we go through this, we want to look at the structure, the funding mistakes, and help go through the practical steps to make sure our client's buy sell agreement does what they expect it to do. First of all, we've got to understand the type of agreement. With a cross purchase agreement, this is probably the most simple buy sell agreement, but it means that the buyers are going to be each of the owners. So this is the cleanest, easiest way to have it. If one of our owners passes away, the other surviving owner buys out their interest, and they have that agreement that says this is what it's going to be, and we want to make sure it's funded properly so that the family, that's expecting to be taken care of is taken care of. Next is a redemption agreement. With the redemption agreement, the agreement is for the company to buy out the owner that is leaving the company, either through a death, disability, retirement, whatever the trigger is, the company is the one that is going to buy that. So when we do this, of course, the agreement has to lay out exactly the terms that the owners are going to agree to for the company to buy them out. Most of the time, that's going to be as a redemption. And so the stock, if it's a corporation, will go back into treasury stock. Finally, the type of agreement I like the most is a hybrid agreement. With a hybrid agreement, it allows the surviving partner, so in a death situation or the partner that's going to remain, they're going to be the ones to decide how this buy sell is going to be treated. So, option one is typically a cross purchase agreement. If the surviving owner, doesn't elect to have a cross purchase, then there's an option for the company to redeem that interest, just like a redemption agreement. Finally, if option one and option two are not elected, then it's a mandatory purchase by the owner, remaining owners, or the corporation, depending on how they set up this agreement. So it gives the survivors the ability to decide what's best for them from a tax perspective, from a funding perspective. But if they fail to agree on what they want to do, there's still a mandatory backstop so that the deceased family's interest is bought out, or whatever that is, so that we make sure we do have a good, valid buy sell agreement. After we have the buy sell agreement, laid out, one of the big questions is how do we pay for the buyout? Now, if you think about the buy sell agreement, it only works if there's enough liquidity to satisfy the obligation. So, last thing we want to have is, this beautiful agreement, but we haven't thought through the funding to make sure it actually would work the right way. So, when we look at this, let's go through the steps. So, first we want to do, look at who is going to buy. Whose obligation will it be to buy out that interest when that partner dies, becomes disabled, leaves the company, retires, whatever the triggering event is? Who's going to buy, whether that's a mandatory buyout, an option? What's the order of purchasers? So understand who is the buyer, who might be the buyer at each situation. Then we want to look at what triggers there are. Is it death, disability, retirement, departing from the company, divorce, bankruptcy, losing a license? When we look at these triggers, the triggers of the buy sell agreement are important. They're important because that's what protects the company. That's what's going to protect the remaining owners, so that if somebody were to become disabled, well, they're going to be bought out because that's what they've agreed to do. Finally, we look at how is the value going to be set? Is that going to be a formula? Is it an appraisal? Is it agreed on a value that's updated periodically? We have to understand that especially if we have a company that's growing in value, if we're going to fund this properly, are we funding it at today's value, or are we building in to make sure that we have funding appropriate not only for now but for the future? And finally, does the funding match? Think about this. Let's say that it's a cross purchase agreement and the insurance is owned by the company, not by the other owners. Well, the funding of buying the life insurance doesn't match who's obligated to purchase that interest. So we want to make sure all of these things match up the right way. So when we look at funding, because funding, the funding method that we look at depends upon the triggers that are building into this agreement. So if we have a trigger being death, well, do we have life insurance in place? That can be term, it can be permanent. What I like about life insurance in this case, it creates immediate liquidity. We don't have to wait for the company to earn the money and create that liquidity so that either the company can redeem the interest or the owners can redeem the interest. We have a death, we have a payout from the insurance company, and we can satisfy that obligation. If there's disability, you can have that disability covered by a disability buyout policy. These are specifically designed to meet what a buy-sell agreement is going to need. Partner A becomes disabled, they can make that claim to the disability company, that money comes in, the buyout can happen. And this is great because it keeps the owners from draining the cash flow of the company. And for those that become disabled, their family receives the buyout that they need, probably to cover their current needs as a family and also the medical needs or whatever for our disabled business partner. Finally, you think about retirement. With retirement, we're going to have, are we planning for this funding event? Do we have cash value in life insurance that we can use? Reserves in our on our balance sheet in bank accounts, investment accounts, or have they been setting aside a sinking fund to make sure when those funding trigger events happen, we've got cash available to start the payment process. If not, we're going to fall back to an installment note that's going to cover either the full amount or at least the remaining interest. But remember, the company has to earn the money, pay the tax, and then use net after-tax proceeds to make this payment. So if we don't do that planning, we're going to be in an installment situation that can be a significant drain on assets because we're using after-tax money to handle this. So can we build this down payment or this payment ahead of time so we're not caught in a situation where liquidity becomes an issue? So think about what you should do next. When we're working with a client, request the actual buy-sell agreement. Make sure it's the current buy-sell agreement and that everybody has agreed to those terms and we're not guessing at what the terms are. Identify the structure. Is it a cross-purchase, redemption, hybrid? What are the triggering events? How are we going to value that interest now and into the future? And what type of mandatory language is there for the buyout? Finally, let's match the policy owner and beneficiary to the real buyer. If we have a cross purchase, if we're using life insurance, we've got to make sure the beneficiary is the owners of the business. Then let's stress test this. Let's stress test what happens in the event of a death, a disability, or retirement, or whatever the other exit scenarios would be. Will there be enough money, enough liquidity to handle a buyout without hurting the viability of the company? And finally, let's make sure that we're reviewing those values on an annual basis to make sure that our funding matches up to what's happening with the business. So if there's major business changes in the business, changes in ownership, changes in value, let's make sure that the funding that we need is in place. Remember, if the agreement and the funding don't match, the buy-sell is not really funded. So when we talk about funding the buy-sell, it's making sure that in the event of a triggering situation, our clients are protected and they've done their planning in a way that makes sense. So I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.